A seismic shift is underway in global energy and finance, one that could redefine the balance of power for decades to come. Saudi Arabia and Qatar, two of the world's most influential oil and gas giants, have just announced a groundbreaking decision. They'll now accept the Chinese Yuan for their energy exports, breaking with decades of tradition. This historic move comes immediately after their entry into the BRICS economic bloc, sending a clear and unmistakable signal to markets and governments worldwide. For generations, the US dollar has been the undisputed king of oil transactions, a system known as the petrodollar, which has been central to American economic and geopolitical power since the mid-20th century. Now, that once solid foundation is beginning to crack, raising questions about what comes next. The BRICS group, now expanded to include Saudi Arabia, the UAE, and Qatar, represents not only a massive share of the world's population but also a significant portion of global economic output and energy resources. Their collective move to diversify away from the dollar is a direct challenge to the post-World War II financial order that has shaped the modern world. The implications are vast and far-reaching, touching everything from the price you pay at the gas pump to the security of your retirement savings and the stability of national economies. The announcement from Riyadh and Doha has sent shockwaves through global financial markets, sparking uncertainty and debate among investors and policymakers alike. For China, this is a major leap forward in its long-term strategy to internationalize the yuan, reduce dependence on the US dollar, and increase its influence in global trade and finance. For the United States, it's a formidable challenge. The dollar's privileged position has long made it easier to run deficits, fund government spending, and maintain global influence. Erosion of this privilege could have profound and lasting consequences for the American economy, its financial markets, and its role on the world stage. The petrodollar's dominance has shaped the cost of goods, set interest rates, and underpinned global economic stability for generations. A shift away from this system could bring new volatility, disrupt established markets, and at the same time, open up new opportunities for innovation and growth in emerging economies. As of October 19, 2025, we find ourselves at the very beginning of a new chapter in economic history, one filled with both uncertainty and possibility. The full story is still being written, filled with economic and political intrigue as leaders and institutions around the world scramble to adapt. The certainties of the past are fading away, replaced by the complex and unpredictable realities of a truly multipolar world. The world is watching closely as history unfolds before our eyes, and the next era of global finance begins to take shape. To truly understand today's seismic shifts in global finance, we need to revisit the birth of the petrodollar, a story that began over 50 years ago and shaped the world as we know it. In 1971, President Richard Nixon made a historic announcement. The dollar would no longer be convertible to gold, effectively ending the Bretton Woods system that had anchored the world's currencies since World War II. Suddenly, the world's financial system was adrift, searching for a new anchor to restore stability and confidence in international trade. After the 1973 oil crisis sent shockwaves through economies, the US struck a pivotal deal with Saudi Arabia. Oil would be priced exclusively in dollars, Saudi surpluses would be invested in US bonds, and in return, the kingdom would receive American military protection. Other OPEC nations soon followed suit, cementing the dollar's role and creating a massive, sustained global demand for US currency. The dollar became the world's primary reserve currency, granting the US what economists called an exorbitant privilege, unmatched financial influence. America could print money to pay for imports and finance deficits with far fewer consequences than any other nation, fueling decades of prosperity and power. The petrodollar system underpinned US dominance for 50 years, keeping borrowing costs low, boosting Wall Street, and giving Washington extraordinary leverage over allies and rivals alike. Control over the world's main trade currency became a powerful diplomatic weapon. Sanctions could isolate entire nations from the global economy with the stroke of a pen. This financial power, in many ways, rivaled even America's military might in maintaining its superpower status and global reach. But critics argued the system forced developing nations to hoard dollars, limiting their policy choices and stifling their economic growth, while making them vulnerable to US policy shifts. It tied the fate of the global economy to the decisions of the US government and its Federal Reserve, for better or worse. For rising powers like China and Russia, dependence on a rival's currency was always a strategic concern, fueling their desire for alternatives. Over the years, they have invested heavily in building alternatives, promoting their own currencies, and forging new financial alliances to reduce dollar reliance. The recent moves by Saudi Arabia and Qatar are the culmination of a long-standing desire for change, signaling a shift in the global financial order. The petrodollar's dominance is no longer unchallenged. New players and new currencies are entering the stage. The world is now more ready than ever for alternatives, as nations seek greater independence and resilience. The stage is set for a new era in global finance, one that could reshape the balance of power for decades to come. The petrodollar era, after dominating for half a century, is finally drawing to a close. A new system is emerging, and the world is watching as history unfolds. The BRICS expansion is central to this story. What began as an acronym for emerging markets is now a powerful coalition. The original five, Brazil, Russia, India, China, South Africa, sought a more balanced world order, with Saudi Arabia, UAE, Iran, and Egypt joining. BRICS Plus now represents nearly half the world's population and a major share of global GDP. The bloc includes top energy producers and consumers, creating a strong internal trade ecosystem. China, the world's largest oil importer, and Russia, and Saudi Arabia, top exporters, now have a framework to trade outside the dollar. The decision by Saudi Arabia and Qatar to trade oil in yuan is a direct result of this new alignment. The shift by the Gulf states turns de-dollarization from theory into reality. For China, this is a breakthrough. Beijing has long aimed to elevate the yuan's global status. Accepting yuan for oil is the biggest boost yet for the currency's international profile. China has built currency swap lines, its own payment system, and yuan-denominated oil futures. With Saudi Arabia now on board, more countries may follow. As more oil is traded in yuan, global demand for the currency will rise, making it more attractive as a reserve. This gives China more influence and reduces its vulnerability to US sanctions. But challenges remain. China's capital controls and less transparent markets limit the yuan's appeal. For the yuan to truly rival the dollar, Beijing must continue reforms and build global trust. This is a major step, but the journey is far from over. The geopolitical implications for the US are profound, touching every aspect of its global influence and economic stability. The petrodollar system has been a pillar of American power for 50 years, fueling both its economy and its international clout. The ability to impose sanctions by controlling the dollar-based system is now under threat as new financial networks emerge. As more trade moves outside the dollar, US leverage weakens, and its traditional tools of influence become less effective. The US-Saudi relationship, once anchored by the petrodollar, is shifting in ways that challenge decades of diplomatic norms. Saudi Arabia's pivot to BRICS and the yuan signals a new, more independent foreign policy, and a willingness to diversify its alliances. For Washington, Gulf influence can no longer be taken for granted, as regional powers seek greater autonomy. The erosion of the petrodollar could mean higher US borrowing costs, increased market volatility, and tough economic choices for policymakers. The US faces a strategic crossroads: confront the shift or adapt to a multipolar world where power is more widely distributed. Overuse of sanctions may have accelerated this change, pushing rivals to build alternatives and eroding trust in the dollar system. America must now navigate a world where its economic leverage is no longer absolute, and competition is fiercer than ever. The era of easy dominance is ending, replaced by a more complex and uncertain global order. A new strategy is needed, one that recognizes these realities and prepares America for the challenges ahead. Accepting yuan for oil will ripple through global markets. The dollar's demand will decline, while the yuan's will rise, likely leading to gradual shifts in exchange rates. Central banks may rebalance reserves, and commodity markets could fragment, with new pricing benchmarks emerging. The link between the dollar and oil prices may weaken, changing long-standing market dynamics. For emerging markets, paying for oil in yuan could reduce their need for dollar reserves and insulate them from US policy swings. But managing exposure to the yuan adds complexity. Investors and corporations will need new strategies to manage currency risks. The assumption of dollar dominance is fading. New opportunities and new risks will emerge in BRICS economies and yuan assets. The transition will be uncertain and volatile. The era of a single predictable global financial system is over. This global shift will affect your daily life. The dollar's reserve status has kept imports cheap and borrowing costs low for Americans. A weaker dollar means higher prices for goods and more expensive loans. Mortgage rates, car loans, and credit card interest could all rise. Travelers and businesses will face more volatile exchange rates and new currency risks. A weaker dollar could help U.S. exporters, making their products more competitive. Even gas prices are tied to this system. A weaker dollar can mean higher prices at the pump. Yuan-based oil trading adds complexity and unpredictability. The stable financial world we knew is changing. Everyday economic life will feel the impact. Moving to a multi-currency system brings both promise and risk. It could democratize global finance, reducing U.S. privilege and spreading power more evenly. Countries would gain flexibility, and competition could drive innovation in financial services. But the transition could be volatile, with fluctuating exchange rates and greater uncertainty. Multiple reserve currencies mean more complexity and higher transaction costs for businesses. The risk of global instability rises as the system fragments. The key question: do the long-term benefits outweigh the short-term risks? The world is entering uncharted territory. The old certainties are gone. Saudi Arabia and Qatar's embrace of the yuan for oil is a historic turning point. The US dollar remains dominant, but its supremacy is no longer absolute. We're entering a multipolar financial world with the dollar, yuan, and euro as main pillars. Nations and corporations will face more choices and more complexity. Strategic hedging and understanding geopolitics will be essential. For the US, this means greater fiscal discipline and a new approach to foreign policy. The dollar's future strength will depend on America's economic fundamentals, not just history. The world is embarking on a great economic experiment. The shift to a multi-currency system brings both promise and peril. The actions of governments and corporations will shape the outcome. The next chapter of the global economy is being written now.